From examining historical patterns to analyzing current economic trends, we'll provide a comprehensive overview of the factors that have brought us to this crucial point. So, fasten your seatbelts and get ready to navigate through the challenges that lie ahead. The world has been in a depression since the 2007 financial crisis that's likely to continue indefinitely. When people hear this, they often object and argue that the technical definition of a recession is 2 consecutive quarters of declining GDP and rising unemployment. However, this definition is not applicable to depression. The National Bureau of Economic Research is the widely followed authority that determines whether an economy is in a recession or not. But we're currently in an expansion phase. So, how can we be in a depression? The problem lies in people's misunderstanding of what depression really is. Many assume that if a recession is 2 quarters of declining GDP, a depression must be, say, 6 quarters of declining GDP. However, that's not the case. A depression is a prolonged period of below-trend growth with no tendency to recover to the trend. In other words, if a country's potential growth rate is 3 to 3.5% and it's been growing at 2% for an extended period of time, it's experiencing depressed growth. While a 1% difference may not seem significant, it has substantial impact when compounded over time. The wedge between the trend line and the actual line grows larger, and we're left with a significant output gap. Over the past 10 years, the US alone has left $5 trillion of potential growth on the table due to this depressed growth. To put it simply, we're losing wealth because we're not reaching our full potential. Using these parameters, it's evident that we're currently in a depression. Unless there's significant policy shift or a collapse, this will continue and will likely remain in a sluggish 2% growth range. Demographics, technology, productivity, and psychological factors are all obstacles to growth, and there's no reason to expect them to change. The situation is not limited to the US alone. It's also true in Europe and Japan, which has been in a depression for more than 2 decades. There are concerns about the accuracy of economic growth figures, with suggestions that infrastructure spending is being counted as growth when it shouldn't be. This means that growth figures may be artificially high and that applying generally accepted accounting principles would lead to a lower growth figure. Furthermore, there is concern that the world is caught in a cycle of debt, with debt increasing faster than growth. The impact of debt depends on whether it can be afforded and used productively. If debt is not affordable or sustainable, then it can lead to a crash. It's important to consider debt relative to income, and the debt to GDP ratio is a useful metric. While GDP is slowly growing, the debt to GDP ratio is increasing, which suggests that a global debt crisis could be on the horizon. The Federal Reserve is expected to tighten interest rates 4 times this year, but this could change if certain pause factors apply. These include a disorderly decline in the stock market, a decrease in employment, or disinflation or deflation spiraling out of control. At present, none of these pause factors apply, which means that the Fed is likely to continue raising interest rates. However, there are concerns that the Fed is over-tightening, particularly given its attempts to normalize the balance sheet. If the US economy were to enter a recession, the Fed would face a dilemma. It typically takes around 4 percentage points of cuts for the Fed to get the economy out of a recession. But with interest rates already low, there may not be much room for the Fed to maneuver. Negative rates are not seen as an effective solution. The topic of monetary policy has been a matter of debate among economists and policymakers, with some advocating for modern monetary theory and others disagreeing. The Federal Reserve has been taking actions to reduce its balance sheet and raise interest rates in preparation for the next recession. However, this approach may lead to a conundrum, as the tightening measures taken to prepare for the recession may actually cause it. There's no data or time series to predict how this will play out, but it's possible that normalizing the interest rates and the balance sheet could lead to a recession. During quantitative easing, asset prices increased while there was not a significant rise in inflation. However, the Federal Reserve is now reducing the money supply, which is equivalent to tightening interest rates. This double tightening may lead to a recession, and the Federal Reserve has a poor forecasting record. As a result, The author is not bullish on growth and is bearish on stocks. Despite the tightening environment, gold has performed fairly well. The author believes that when warning signs of a recession emerge, the Federal Reserve will reverse course and pause at one of its meetings, causing gold to skyrocket. This would signal that the Federal Reserve cannot get out of the easy money mode, and the economy may be sinking. The author stresses the importance of backing up any claims or forecasts with data and analysis, as the methodology used by Wall Street forecasters is flawed. Every year, the Federal Reserve Bank releases a one-year forward forecast, predicting the state of the economy in the upcoming year. However, their predictions, along with those of the International Monetary Fund and Wall Street, have consistently been off by a large margin. Economists have been wrong more than half the time, and they use models that are flawed, such as the equilibrium model, the efficient market hypothesis, and stress tests. These models don't consider the unpredictable nature of the markets, which are not in a state of equilibrium and can have large sudden gaps in price. As a result, forecasts have been inaccurate, and the reasons for this include flawed models and the tendency for economists to follow the herd mentality, rather than going out on a limb and risk being exposed. Economic analysis of business cycles, recessions, and depressions is a conventional approach, but it's not sufficient to explain financial panics. A financial panic is a different category of crisis and is the worst thing that can happen in an economic system according to complex theory. The severity of the crisis is an exponential function of the scale of the system, which refers to how big it is. Various metrics can be used to measure the scale, such as the gross notion of the value of derivatives, average daily volume on the stock market, and debt. Although this science is relatively new, the theory is sound, and it suggests that if the system triples in size, the risk of a crisis grows by a factor of 10, 50, or more. Some believe that the 2008 financial crisis taught us a lesson, and we've since brought debt and derivatives under control. However, the total value of derivatives and the debt-to-GDP ratios are much higher than before. The concentration of banking assets is also more concentrated among the top 5 banks in the U.S. The risk hasn't gone away, and if anything, the next crisis will be exponentially worse than the last. This is an objective statement based on complex theory, which suggests that a crisis is inevitable and could occur every 5, 6, or 7 years. The problem is that we're not ready for this crisis, and it's unlikely that anyone can bail out the central banks when the crisis hits. Only one institution, the International Monetary Fund, or IMF, can print its own money and has the balance sheet to provide a bailout at a higher level. However, the IMF is not fully prepared for this role, and the international community has yet to discuss and agree on a contingency plan for a financial crisis. That's all for this video. We hope you liked it. If so, hit the like button, subscribe to Monetary Overwatch, and turn on the notifications so you never miss a video. See you in the next one. Till then, take care and thanks for watching.